At the moment, UK holding companies benefit from the EU Parent Subsidiary Directive, which exempts them from withholding tax on dividends paid by the subsidiary to the parent. This will no longer apply after Brexit. There is a secondary form of relief available under the terms of double tax treaties concluded between the UK and the jurisdiction in which the subsidiary is resident. However, they're not a cure-all. Withholding tax may be payable even if treaty relief is available. So, for example, dividends paid by a German subsidiary to its UK parent may attract withholding tax. What all holding companies need to do is review their group structures and see if the group can be reorganised to minimise any withholding tax exposure. Brexit may increase borrowing costs under the terms of loan documentation. Standard loan documentation passes any costs of withholding tax onto the borrower. Post-Brexit, interest payments between associated companies will no longer benefit from the EU Interest and Royalties Directive. As a result, the cost of interest may go up via withholding tax. Other reliefs can be available, such as relief under a double tax treaty. However, it may not be available in all cases and it has to be claimed. So borrowers should look at the terms of the loan documentation and see what the effect of withholding tax will be, and then consider how the loan can be amended to reduce that impact. Anti-avoidance rules could be strengthened as a result of Brexit. Important UK anti-avoidance rules have been subject to limits to make them compliable with EU law. These would include the Controlled Foreign Companies rules and also the Transfer of Assets Abroad rules. Post-Brexit, the limitations need no longer apply, although it's a question as to whether the new governments, would actually take the opportunity of increasing and strengthening anti-avoidance rules. There could be a tax upside from Brexit. At the moment, several UK tax rules or tax reliefs have been restricted to comply with EU law. For example, Enterprise Investment Scheme. Post-Brexit, the government will be able to actually soften the rules, enabling more companies to qualify to incentivise investment in the UK. In addition, anti-avoidance rules, which are EU-based rules, needn't be adopted by the UK going forward. However, one important set of rules concerning disclosure of activities concerning offshore companies is being adopted by the UK despite the fact we intend to leave the EU. So maybe the anti-avoidance rules will stay, but there could be a softening of the UK tax regime to promote investment. And finally, the UK could reduce the rates of taxation, again to give a stimulus to the UK economy.